Welcome to our Holistic Investment YouTube channel where we break down complex financial concepts into simple and easy to understand insights. Today, we are diving into crucial metric you need to understand when evaluating your mutual fund's beta. What exactly is beta? Beta measures the sensitivity of your mutual fund to market movement. In simpler terms, it tells you how much your fund's returns might fluctuate in response to the ups and downs of the market. The market usually represented by a benchmark index is assigned a beta value of 1. If your mutual fund has a beta of less than 1, it indicates that your fund is less volatile than the market. On the flip side, a beta greater than 1 suggests more volatility. For example, let's say your mutual fund portfolio XYZ has a beta of 0.70. This means XYZ is less volatile, and for every 1 point rise or fall in the market, XYZ's value may only change by 0.70 points. So if you have a low to medium risk profile, you should consider funds with lower beta. But there is more to the story. To get the full picture, you should also look at how closely mutual funds portfolio tracks the benchmark index. That's where the R squared value comes in. R squared is a statistical measure that shows how closely your fund's movements mirror those of the benchmark. The value range from 0 to 100. A higher R squared value, typically above 80, indicates a strong correlation between your fund and the benchmark. Remember, beta is more effective when your portfolio closely follows the benchmark. If it doesn't, relying solely on beta might not give you an accurate picture of your fund's risks. So when you are evaluating your mutual funds, check both the beta and R square values to understand the risk and correlation with the market. Thanks for watching. If you find this information helpful, don't forget to like and share and subscribe for more financial insights.